Okay, so let's get started. My name is Brian Hanley, and this talk is about banking and finance for Mars. So why should we care about this? Money is a primary obstacle to development, as everybody in this room knows. And engineers, scientists, people like that are generally, they're really good at problem solving. They can get the math, but they don't understand what money is, how it works, et cetera. And without a flexible and sophisticated system on Mars for creating money, we're going to be in, I mean, it'll be terrible. We need to create a mechanism that will allow lots of money to be created to do new things at an extraordinary rate. And there is precedent. Many people know that Benjamin Franklin was a printer, but most people do not know that what he printed, the big thing he was known for was from 1726 until 1764, when it was outlawed, he printed monetary instruments that the colonies used as money. So what are we going to cover? We're going to cover fundamentals of money and banking. This is going to be a fire hose. We're going to talk about venture banking, and we're going to talk about a Mars bank structure. So let's start with money and how it evolved. Hard currency, which is what most people tend to think of as money, started with really arbitrary things. It started with gold. It started with, you've got gold, you've got diamonds there, and you've got a wampum necklace. And I hope the formatting of this works better for other slides. Accounting actually came first, archaeologically. Counting did, and then counting gave rise to writing, and writing allowed us to start keeping records, which allowed things of value to be kept in vaults, and you could exchange either clay tablets, as in the Assyrian Empire, or you could exchange letters to accomplish trade, and that allowed you to be protected from robbery and theft. So you had the slow appearance, well, actually the first appearance in the world was in China of paper money. So let's talk about, how many of you have heard of the Medicis? Okay. So let's talk about what the Medicis were really up to there. They were they kept vaults, and they kept money for other people. And what they did was they would manage their money. They would lend out the principal plus interest as paper notes, lend out the money as paper notes, and they would receive back the principal plus interest. And they would do that for their own money and for other people's money. And when they did it for other people's money, they took a cut of the interest. So then they started doing this thing which had happened before, where they loaned out more money. They made loans for money they didn't have in the vault. So when you think about this, how much did they make? How much money did they make when they were paid back for the principal plus the interest? In the old way, they were just making interest. Now they were getting the principal plus the interest, because the principal hadn't existed before they made this loan. And the Medicis were very worried at the time that they were doing this, that they were going to get caught, and the people were going to rise up and kill them. This didn't happen, and you know what one generation does as a scam. If it works and people are kind of happy with it, well, the next generation is tradition. And this is how the reserve banking system started. And what the Medicis were doing was they were loaning out up to double the amount of gold and silver they had in their vaults. And that's why they got rich, and it's also why their city got rich. And they were friends with the Rothschilds, and the Rothschilds got picked up on this, and they started doing it, and you've all heard about the Rothschilds. So the money they had in the vaults were their reserves, and it was a 50% reserve system. And over time, over the centuries, we had in Europe to allow more money creation, because once you run up against the limit of how much you can create, well, you're stuck again, just like you were with gold. They dropped the amount of reserves that were needed in order to be able to create more money until they started dropping to levels where you could get a run on the bank, and you run out of gold, and then people would realize, oh, you know, the bank is empty, and then everything crashes. And so you developed, we developed prudent practices and regulations. There's a lot of regulations today. Nations picked up on this, and they figured out how reserve banking worked. They started issuing paper currency based on gold and silver and things like that. And then there was a really interesting thing that happened. In 1844, the British government commissioned Thomas Tooke to study the Bank of England and tell them, what's going on here? What's happening on our bank? He had a number of major findings, but the crucial finding for our purposes here is he found out that, first of all, the bank managers who managed the vaults all over the country really didn't want to have the gold and silver in their bank. It was an invitation to theft. Have any of you guys seen The Italian Job, the movie? Okay, that's why you don't want to have gold in your house, and it's also why the more something like that you have, the more likely somebody's going to try and take it. So he found out that, and he also found out that the Bank of England had, which was a national bank commissioned by the king, had exceeded their gold reserves by a lot. And you know what? It didn't matter. Nobody cared. Didn't matter. The gold was just sitting there anyway. Nobody cares. So this was the start of thinking about, well, maybe we don't actually need gold. We don't actually need silver. And this happened around the same time that the world ran out of gold. Because, as you can see, population was increasing. This is Tooke's time, and then it really took off. So by 1913, we chartered the Federal Reserve. Now, what is the Federal Reserve's job, or the job of any central bank? It is to replace gold, replace silver with good management practices. And one of the major things they do is they buy assets from banks in order to give them more reserves to be able to lend more. And if you think about it, all those people, every single one of those people that was added to the world's population, all of them need money. So you have to create money at an exponential rate to keep up with them. And then you also have this matter of technology increasing the utility value in the economy. The utility value is all this stuff. These projectors, our computers, our phones, that's utility value. Things, our clothes, things people use. And it doesn't, although the neoclassical school of economics does treat it as, doesn't really deal with money, they just assume it just works, and they're working just with the utility economy. In the real world, money matters. So, with that as a foundation, I'm going to launch into venture banking. Now, venture banking is a new method of banking that I developed. It's based on an analysis I did of the 2008 crash and how to aim that new mechanism at a sector that is creating new utility value at a rapid rate. So, what's the problem? Venture capital has a really serious problem. And on this top layer, this top line, what we see is these are, Series A is like the first round of financing you get after you've set up a company or doing something, after seed round. On average, their 10-year return, their 10-year losses are like 33%. And then it's only the later rounds where they generally make money. And overall, as you can see here, this is the Kaufman Fund portfolio. It's 99 funds. Sadly, they didn't quite get to 100. I wanted them to have 100. And this is what Kaufman Fund saw as their returns on the money that they invested with the VCs. And what you see is the median venture capital fund makes nothing, loses nothing over 10 years, which essentially means they're losing some money because of, the effect of inflation. So let's talk about how venture capital works. You've got your managed funds, pension funds, endowments like Harvard's endowment, et cetera. You've got qualified investors, people of high net worth who have a lot of money. And they give money to venture capital firms who put it into deals, and they write what are generally convertible notes to those companies, and they take equity positions. At some point, when those companies exit, if they exit positively, then the venture capital firm gets 20% of the profit, and the managed funds get 80%. The venture capital firms also charge a 2% per year fee, which you can understand if you're here, because if you're anybody below, if you're basically anybody in the bottom 2/3, you know that you're really not going to make doodly squat unless you charge that. That's really what you're after. So, how does this work? Instead of doing it that way, the limited partners, and there will be a diagram on the next page to help you through this. The limited partners provide money to the venture capital firm, but the venture capital firm puts this money into a venture banking utility, and that utility makes them owners in the bank, so their money becomes part of the base capital of the bank. There's Tier 1 and Tier 2 capital. Tier 1 capital is, and these are defined by the Basel agreements on international banking. Tier 1 capital is at risk for the owners of the bank. They are paid off last if something really bad happens. Tier 1 capital can be, up to 15% of that can be insured assets, and Tier 2 capital can be all insured assets and can equal Tier 1 capital, but it can't exceed it. So when you do the math on that, you find out it's a 47x multiplier on the money. So the VC, the venture capital fund, they write the same kind of convertible note, but they do it as a loan from the bank. And now remember how banks work. Banks, when they write a loan, that's new money that never existed before. And many people don't realize this.
Say that again, please.
Just like the Medicis did.
Yeah, say the sentencing.
Yeah. When a bank writes a loan, that loan is new money that did not exist in the world before it was created. So, simultaneous with this loan, the bank will acquire a default insurance note. Now, some of you might know a little bit about this thing called credit default swaps, where you get a loan for a house, and then an insurance company would write a credit default swap that would cover the bank in case you stop paying on the loan. We do the same thing, but for the venture capital investment, which is high risk, but it's also got some really high rewards. And overall, it does return positive with this. That huge portfolio you saw, the average of it is 1.31, which when you divide by 0.8 is about like 1.5 something. So they actually are making some money, which is all you need for this mechanism to make you fly. So if the venture, when you exit, returns less than the loan, then the underwriter pays off the note, pays off that note, and gets whatever equity in that company exists, whatever it is. They value it as something, and then when, as part of that termination, the underwriter gets a lien on the assets of the bank for approximately 75% of the value of the difference between what that equity in the company was worth and their loss. So they're going to get back eventually 75% of that. Now that'll typically be in like 5 years' time when the venture capital firm closes out a portfolio and they have the money to pay it. So here's the full diagram. See how this works. So you have the venture bank utility. They put their money into we'll call it Bank One. These are managed as like accounts within the bank, and they make a loan. They get a default insurance note. Those have to stay together. You can't separate them. That's part of the legal language of these contracts. And that money is put into equity investments. Now, if the equity investment exits greater than 1, then half of that equity goes to the underwriter and half of it goes to the bank, which is how the underwriter is compensated for the high risk they're taking. And if the investment returns less than 1, then all of it goes to the underwriter, and they pay off the rest. And then at closeout, the clawback lien goes back to the underwriter. So, this is one of those formatting things. Okay, we walked through this. I won't spend a lot of time on that. Let's talk about the clawback graph behavior. So this is a two-dimensional one for it's okay. This 0 is actually a loss of 50%. The reason that this numeric scale down here is the way it is for technical reasons. It made the simulation run really slow. Also, I wanted to make sure I didn't make an error, so I left it that way. But you can see on the top there that 0.5 means it's a 50% loss. 1, however, is 1. That's a return of 1, and everything above that is correct. Now, what you see here is if you have insurance and you have no clawback lien, which is the situation that happened with in 2008, what you see is that most firms are going to be in this blue window. They're going to lose a little bit, or they're going to make like a maximum of about 1.8 on their money. And what you see there is there's a trough. There's a low point there for most firms. So if they realize this, they're going to go blow up everything because that's how they make the most money. So you can't allow that to happen. You have to have this clawback lien, and that way you get a nice smooth curve that.
Could you explain the clawback briefly again?
Okay.
That word means.
Here.
Okay. Maybe you can clarify in what you want me to. This here?
Yeah.
Okay. What this is that when the underwriter pays out in this dotted line, pays to the venture bank, pays off the note, so they invest $1 million, and the company goes bust in 5 years. In my modeling, I say you have to buy at least 5 years worth of insurance. the company goes bust in 5 years, then, or just, there's sometimes called dead fish in a portfolio. It's a company that's bumbling along. It basically, the VC firm knows it's never going to go anywhere, but it's just going along, and they feed it a little bit of money, and that allows them to keep collecting their 2%. Okay, that's the motivation for dead fish. So, if one of those exits, well, it's going to be worth something, but it's not going to be worth, the $1 million they put into it. So the difference is what the clawback lien is for. And approximately 75% of that difference is what is paid out when the underwriter closes out a portfolio of investments that went along with this one, and they will have the money. Okay?
Thank you.
That was a good question. No, I appreciate it. So over here we have a three-dimensional diagram, which I'll show you more, but you can see here that as the multiple of capital goes up, so this is for a multiple of capital of 1. And so as the multiple of capital goes up, you can get to extraordinary earnings if you blow up everything. And basically what you're doing is you're killing the insurer, because that can't work, and that's what happened with AIG. All right, so here's a really fancy graph, and I've got these in papers that are where it's explained more. So what are we looking at here? This graph is for 2% interest rate, because in my modeling, I assume that if there's a clawback lien and it sits for 5 years, the company has to pay it back with interest at 2% per year, or some rate, 2% or 6%. Similarly, the opposite. You have both sides covered. So what are we looking at? What are these layers? Each one of these layers is a classical venture capital return, portfolio return. So if you have a classical portfolio with a return of 1, that's what this sheet is right here. If it's a return of 1.2, that's what this sheet is right here. If it's a return of 1.4, that's that sheet, and we go all the way up to a return of 2, which for very large portfolios is kind of like, that's like having aliens land in your backyard. I mean, it's not very common. What are these spikes here? Those spikes, because this scale is return on investment, those spikes are divided by 0. That's the limit. And what that means is from there on, your ROI is is meaningless, because all you're doing is making money. You don't have to invest anything into the company, into your underwriting firm at all. And these scales here, this is discounted clawback sale, which means when the insurance company closes out a payoff and they have a clawback lien, they can sell that lien in its entirety, or they can sell that lien at shares in that lien at a discount. And what that does is that changes their bottom line, because they have to invest less in the firm because they're getting better cash flow. They're getting cash flow early. Similarly here, for the investments that they have not closed out, that look like they're going to win or do win, they can sell off up to 70. I'm saying they can sell off up to 70%. The reason I limit it to, I say they can't sell off 100%, is because there needs to be an entity. Remember when I talked about how AIG? About how AIG got, they got creamed on the real estate. Well, what was happening is they were being given all this real estate, and they weren't expecting to have that happen. So they didn't have any mechanisms in place to handle it. So you had houses that would just sit, and then homeless people would move in, camp there, just, wreck the house, kids would throw rocks at the windows, all that kind of thing. And by the time somebody caught up with it, there was, the asset was worth way, way, way less. So you have to have some kind of entity that's prepared to handle receiving equity and doing something with it.
What are the units for ROI? So underwriter ROI is that percentage of what their initial investment
That is, that's not a percentage, that's a multiplier. So if this was percentage, you'd put 2 more zeros, that'd be 2,000. So you're going to have, okay, so way down here somewhere is, I've got some other graphs that go into detail about the really low levels, but you have like 0.8, 0.6, I mean, you can actually do okay. The underwriter does okay, even when the venture capital firms are really doing very badly.
And just to be clear, the discounted clawback sales fraction, that's the 75% you mentioned earlier?
Yes. Yeah.
And who is the underwriter?
Well, that's, that remains to be, it has to be some,
Bank?
Banks write, for a long time, only banks wrote credit default swaps to each other. And because they were all banks and they knew what was going on, they knew each other, they didn't screw each other over. But then AIG got into the game doing it bare. They weren't a bank, they were an outside party, and they were selling at a lower price because they had a model that said they could do that.
But in the typical case, what kind of an entity is the underwriter?
Yeah, explain underwriting. because
Underwriting
it's all my life.
is a form of insurance.
Okay.
It could be a bank, it could be, it could be Lloyd's of London, it could be AIG.
So you have 2 actors here.
You have two actors,
You
yeah.
have VC firm, actually, VC firm, the underwriter, and the limited partners.
Well, the limited partners don't really enter into this that I'm showing you here. The limited partners will do really, really well because they're going to get 0.8. I think what's going to happen is that VCs are going to negotiate. We want more of this because you guys are, we want to get half rather than 20% because we're going to make a lot of money here for you, and so we just, deserve that. I think that's how it's going to work. But let's not get sidetracked on that. So this is the venture bank side, and what these scales are. Let's talk. I'll do the scales first. MOC is multiple of capital. I remember when I said that when you do the math on the tier 1 and tier 2 capital and the money that the owner goes into tier 1 capital, and that allows you to loan it out up to 47 times. That's actually a low estimate, but that is the multiple of capital. And that's a crucial feature of this because what you're doing is you're creating new money because you're operating as a bank. You're not being a money lender. Money lenders have to get really high return on their investment. And then this here is the average VC portfolio return, which again, 0 is minus 0.5, and then once you get to 1, it's accurate. So what this is saying here is that when you get out, you're going to be underwater. That's the blue, that's break even there, the blue plane, until you get out to, about 20 to 25. But even if you're losing 50% on your portfolio, if you can get your multiple of capital up pretty high, you're going to do better than almost every VC firm on the planet does today. That's in a 2% interest environment. I'm assuming on this side of the model that the VC firms are borrowing the money they use to pay their insurance premiums.
So that 2% then is on the money that the VC is lending. So the VC.
No, because, okay. We're getting kind of distracted into detail. We can go really deep into this model, but
I'm just not sure who is paying the 2% on
the VC is paying the 2%
to.
to some entity, which could be themselves, which could be their own venture bank.
That loan them their initial tier 1 capital.
No,
Tier 2 capital?
no. The tier 1 and tier 2 capital goes into the bank as an owner of the bank, of the venture bank.
So to the underwriter for the underwriting, who is this 2%?
What I'm, okay, this is a technical point, but essentially what I'm saying is you have a VC and they get some amount of money in, and then they have to pay every year for 10 years. You can't hardly see that these are really bad. They have to pay every year for 10 years a premium to the underwriter. So how do you account for that cost? And so in the model I said, oh, we're going to account for it as they're borrowing against some entity, which could be themselves. But you need to account for it somehow in the system. It's not just free. So then at 6% in a 6% interest environment, what we see, in a 6% interest environment, what we see is, well, if you're operating at 50% loss, you can't quite get there. But if you're operating at around 30%, you're still going to be able to make money. Okay, so now that you've absorbed that, we'll hit Mars banking and how this will work. Saying I'm proposing 3 types of base collateral for use in backing loans, which is resources, engineering and manufacturing capability, and energy. Now, this comes from some diligence work that I did for investors. So these three types of collateral would be discounted based on the time, energy, and the work that's needed to deliver them. So I have this example of, say, 10 million tons of methane from the methane seas on Titan. To use that as collateral, you would have to be able to show a timeline, an engineering plan, where the energy and manpower would come from, in sufficient detail that a venture bank would be willing to invest. And also you need to show the location where it'd be delivered for whatever human use, and some kind of a pricing valuation and how people would use them. So you'd have a company starting from an engineering plan. They might have that collateral discounted to like 1%. But as they reach various milestones, it could get reevaluated. They could be evaluated to be worth more. So for instance, say a company with the equipment and the manpower ready to go and get it would have a much smaller discount. Say maybe they would get 15 to 20% of the potential value if when they delivered it. And then we would allow banks to write default insurance notes for up to 15 years rather than 10, and we could go longer time periods if necessary. We would also have an open market for default insurance note shares that cover the risk of individual loans. Now, this is a really interesting idea because there is no current mechanism for the public and for other entities to participate in the investments that venture capitalists do. You can't do it. You have to be a high net worth individual. But there's really no reason why not. And those pre-sales of those investments are essentially a kind of new stock future in venture capital. And here I would say instead of 30%, 10% of the default insurance note shares would have to be held by an exercise competent entity. And I would also say that the insured collateralized capital would have no limit, rather than saying that tier 2 is limited to the value of tier 1. Just say, you know, remove that entirely, because in an environment like on Mars or in space in general, you're going to have a fantastic need for money creation very fast. And it's going to be valid stuff. I'd also say that the loans would be reviewed on a regular, like 2 to 5 year basis, and revise the price valuation of the collateral on that basis, which is different than, nothing like that is done today. And that these default insurance notes for banking would only, well, they could only be used once on a specific asset, obviously. I mean, that's an obvious form of potential for fraud. And the plan is the initial asset, and then that should increase as the plan executes. Don't allow the valuation to rise faster than the long-term inflation rate, except to the degree that the utility value also rises. You know, if they built equipment, if they built, like if you built a spaceship to go to Titan and land and pick it up, well, that's a built asset. That's something real. That's real utility value. Okay, so this is a chart of it. You have engineering, energy, and natural resources go into a plan. That can go into collateral valuation. It might just go back into the plan for a bit, but then at some point, this will be accepted as potential bank capital, and then you get a discounted, you have the collateral discounted for the loan, which would then, which would also, sorry. You'd have the collateral discounted for the loan, which would go into loans made as, and those would increase as the plan executes. This chart got messed up by the formatting of a different version. The default insurance note would operate in the same way, and that would, and the thing about the default insurance note is, and the reason that it allows you to loan the money out over and over again is that because the default insurance note makes that loan into an insured asset, that insured asset goes back into the capital account. And this is a key piece of what was happening in the run-up to 2008, was the banks had created, by accident, as an emergent phenomenon, they created a brand new, novel money creation mechanism that had never existed before, ever. And if you know anything about finance and money, the rarity of an event like that is like once every 1,000 years. It's really unusual, but that's what happened then. Then, okay. So the main thing here is I added here the central bank. I think that you would want to have a central bank for Mars, and on Mars, and it would do the same thing as a central bank does here. But it would also be an asset buyer for the banks, for the venture banks.
Where's the VC firm in all this?
Well, that's the venture bank. Well, in this essentially what I'm saying.
Right there.
Yeah, essentially what I'm saying is, and the PDF looks better. What I'm saying here is that we would operate the banking system on Mars essentially as a venture banking system, or a major part of it. And that would be the norm rather than something new and exceptional. Because that's what that environment would need. It's going to need the ability to have people just say, well, we need to do this, we need to do that. Okay, we're going to give you a loan. Let's go do it.
I would suggest that you rethink that, because I could see how private companies would accept equity, selling their equity, even control of the equity to a VC firm, but maybe not want to borrow. If you're talking about a bank.
Pretty much, I mean, I speak also as an entrepreneur.
Yeah.
Pretty much most entrepreneurs vastly prefer to get a loan from a bank over getting money from a VC.
Sometimes.
Pretty much, because it's so much cheaper. But in this anyway, in this case, what we're talking about, we need to create a mechanism that will will make it possible to create massive amounts of money really fast that is directed at real asset creation, real utility value creation. And this is a mechanism that can do it. Now, I'm really sorry about the way these charts turned out, because that's an artifact of this, there being a different version.
Let me ask you, just initially though, will the underwriter be on Earth, but the lender will be on Mars?
That remains to be seen. I would prefer to see it all happen there. I mean, you'd want to have it set up and happening there, because people here are just not going to get it. And also, you know, I mean, I've talked to VCs here. You know, most of them are nice guys. They're from the Ivies, most of them, and you know, they're really, you know, they have a lot of stress from worrying about whether their investment's going to work, but most of them really are not able to judge whether the investment is going to work either. But, you know, so it's just, you know, I don't think that's going to work for very long. And it didn't work in the Americas. You know, that's, Benjamin Franklin testified after the revolution. He testified to Parliament, because they asked him, he said, why did, you know, we're nice guys. Why did you rebel? What was the problem? And he said, well, the problem was the 1764 Act, because there wasn't enough British currency in the colonies. We couldn't do business. When you told us, when you destroyed our money by outlawing it, we couldn't do business anymore. So what are we going to do? So he said it was the 1764 Act that made the difference. I mean, that's what motivated the moneyed elite to say, hey, we got to do something.
You can email us the corrected PDF, maybe.
Yeah, well, I've got actually the PDF here. We want to just look at that.
Incidentally, will the borrowers be entities, legal entities?
Yeah,
Martian law, legal entities?
some kind of legal entity.
So to that point, kind of, in terms of what currency this is being done, and I assume that the majority of this is occurring in Martian currency.
Again, that remains to be seen. Probably.
Because I would think that if you're...
It could be. But the thing is, when you look at this mechanism, once you understand how this mechanism works, you will realize it doesn't really matter what currency you use. You could do it in dollars. You could do it in yuan. You could do it in...
From the regulatory side, because if you're doing this in U.S. dollars, you must comply, I assume, with U.S. law to get the U.S. dollars, to get the...
Well, Panama runs on U.S. dollars. Mm-hmm. You know, there's nations that use other nations' currencies, and they do all right. You know, there are other issues with that's a rabbit hole that I want to go down, but
I think it's fundamental to this, because I wonder if you do this in Martian currency. So say you start in Martian currency, just as a hypothetical.
What's the exchange rate?
Right, exactly. Yeah. And why don't
my prediction is the exchange rate. Well, the exchange rate will be where is the currency, where is the stuff? It's because it's like.
But if I've got 1 million Zubles, why does someone from the U.S. want that?
Well, the thing is, it won't really matter if you're doing all this building on Mars. See, if you're doing it from that position, it won't really matter whether an entity on Earth values it at. The discounting issue there will be similar to the discounting issues when trade was in sailing ships, and so the farther you got from the port, the less that money was worth. Blah blah blah. Yeah.
I like what you've done here, and I've worked through a lot of this independently, but one of the things I would have, going back to that point, is I would keep this firewall away from the fiat currencies on Earth, because you don't want currency, the currency speculation engine that cranks through so much money but produces nothing, to infect an economy that's built on getting things done. I would also think of how to incorporate smart contracts and a more credit union sort of system.
Okay, credit unions and that kind of thing, that's a totally different issue.
Yeah.
And Bitcoin and blockchain are another rabbit hole to go down. I've got a talk on that I've delivered. I've got a paper on that I've done. I've got, there's some serious issues with it, but I don't want to get, I don't want to really go off on that for this talk. The main thing I want you guys to come away with is there's a lot for you to learn, and this fundamental concept that banking is the original disruptive innovation. Okay? Because of banking, Europe exploded across the world. That's what drove it. I mean, that having all this money, having all this money available, and having for the first time having the decision as to whether you're going to get money being made by people who are not, noblemen of power who got their power by military force was huge. And that started the clock ticking on royalty. It took a long time, but it started the clock ticking. The ability to create money in the present based on promises to pay in the future was a huge revolution. And there are instances in history, in 20th century history, for example, the USSR, where they didn't have credit. And they couldn't do that. They didn't understand it. Russia has since remedied that. And as a result of that, they had to recreate slavery to motivate people to work. And that's what the gulags were. So while it doesn't force it to happen, the invention of banking allowed the world to eventually drop slavery. Yes?
Do you foresee the investors in the Martian bank being Earth people?
Initially,
I would think.
Initially, yeah.
That's where the money is.
Initially. But you could create this from scratch. You could. You just, because you've got, if you create a central bank, the central bank, there's this idea that fiat currency is bad because there's nothing behind it. There's no gold, there's no that. But hopefully that's one of the things I've helped to educate you is it's just wrong. It's not, it is so wrong that, most serious economists won't even deal with the issue because it's just like, don't bother me with that. So you can just declare some initial money, which is essentially what Bitcoin does. They're just declaring money out of nothing, but if then you say, okay, we're going to manage this now, and we're going to say, we're going to make loans, and a loan is creation of new money, based on what you guys say you're going to do, and based on our evaluation that you can do it, probably, that you can do it. There will be failures. But again, remember, and this is, we were talking about this with an investment banker, and I said, yeah, you got to remember that when a bank makes a loan, and I have one of my papers, I have this in the introduction. You loan $1 million to build a castle, and at the end of that time, the castle is only worth $500,000. The builder goes bust. The bank takes back the $500,000 castle and sells it for $500,000. And I have the accounting that shows that this bank's still ahead. The bank is ahead $500,000 because they created that money out of nothing to begin with. And this is one of the, and he goes, and he started laughing. He goes, yeah, that's, yeah.
Wait, but didn't the bank part with $1 million?
Again,
Builder.
Remember what the Medicis did.
$1 million opportunity.
The $1 million was created when the loan was written. That's virtual money. We function on virtual money. There is a one-to-one correspondence in the modern world, almost one-to-one, between money, credit money, positive money that you guys use, like in your wallet, in your bank account, and debt. For every dollar of one, there's a dollar of the other. Because all money in the modern world is debt. That's how it works.
So,
And that is the revolution that the Medicis created with what started out as a scam. But it worked and it made everybody rich. And it made, I mean, we are relatively rich by comparison.
and so for the terrestrial analog, I guess the person controlling lending reserve ratios is the Federal Reserve, right? Like in terms of how much money, like, so if I'm a bank and I've got $1 million in the bank, the reason I'm allowed to say you loan out 20 times that loan out $20 million is because the U.S. Federal Reserve says I'm allowed to create $20 million worth of loans. Is that correct? Or,
That's a regulatory matter.
but I mean,
yeah.
I think that's key
Yeah.
to what you're saying.
Yeah. The research, see, there have been, actually, I forget which agency regulates that, but there have been banks in the past that have been approved to have, instead of having, say, 5%, they've had like 2% reserve ratios.
But that approval, I think, is kind of the key to this whole thing, right? Like,
Well, the thing, and that's what I'm getting at, is that I want you guys to start thinking, and if you know any sci-fi writers, we have to start putting how money works and what it really is, rather than some guy's, just idea that he got from the internet. And well, I've likened this in the past, when I talk to engineers and scientists, mostly it's kind of like talking to fish about water. You're swimming in it, but you don't understand it. You don't know how it works and what goes into it. And so people make mistakes like saying that because there's all this debt, that's a problem, and we have to fix it by paying down all the debt. Well, this is something that the British Empire figured out way back around the time of the American Revolution. And I got this from Jeffrey Gardner, who was the #2 guy at Barclays Bank. And he's reviewed this stuff, by the way. He was one of my people. He thought it was really interesting because he said this could solve a fundamental problem in banking, which is that deposits tend to be short-term and business needs tend to be long-term. So he was kind of interested in that. But he said, well, the Bank of England has still not retired most of the debt from the American Revolution. I'm like, what? I said, no. And the reason is that they figured out way back then that debt had created money that people were using in the empire. And when if they paid it off and they destroyed it, that would cut their money supply. And this was key to the ability of the British Empire to extend across the world, because they were better at increasing their money supply in concert. Now, they didn't, obviously, as Benjamin Franklin told them after the American Revolution, they didn't do it well enough, but it was, they were like right at the edge of being able to, but it allowed them to do this.
Well, the counter argument of that is that's also in the gold standard with Sir Isaac Newton came out. That's also been credited with helping to expand British.
Well, Isaac Newton did some really weird things.
Gold for gold.
He ended up getting kicked off that position, becoming Chancellor of the Exchequer and going after counterfeiters instead, because he was doing things like having them put a fixed amount of gold in, even if that made the gold coin worth more than the face value, which meant that there were folks in Scotland that started ordering a lot of gold coin and then selling it back to the mint after melting it down. And he's got in his book, he's got a very good book called The Evolution of Creditary Structures and Controls. I highly recommend it. It's actually Jeffrey Gardner, yeah. And it's quite readable.
Yeah, that's the thing, is I've read a lot on different aspects of this and come up with some stuff, and I like a lot of what you're saying, I like everything. But what I'm curious about is like that, like when you try to find information about details of the whole thing with the creation of the gold standard, you start hitting walls.
Well,
where there's just not good books on the subject, so I'm glad you found some.
yeah, well, yeah, you're right. There's not a lot of good books on the subject, and although there is in, monetary economics and banking, graduate course kind of stuff, I mean, bankers understand this stuff. Going back, what was that? So, yeah, there we go. So this is, this has been an hour, which is actually shorter than any talks I've given like this. And I hope that some of you have learned something. This is the beginning. This was, I gave you a huge amount really fast, and to really understand venture banking, you would have to you'd have to read my papers and chunk through them, and it's a bit of work. But once you get it, it's like, oh, yeah.
Okay, so last year you were talking to us about this,
Part
and
of
it
it,
was all
yeah.
theory. Now, when you started out, I couldn't tell, have you implemented this?
I am
Still-
closer. I haven't implemented yet. No, I am closer to doing that. I mean, I've got more. Anytime you do something like this that's really kind of radical, I mean, it's first you have to find the people who get it, there's a lot of people in DC that I've sat with, and they just 2 hours later, they're like, "Oh, this is really deep," this is really this is hard stuff. And then once in a while, you see some guy and you talk to him for like 20 minutes, and the eyes light up, and he's like, and then he starts saying, "Well, so what's your ask? What do you want to do here?" If you get it, and in any kind of process like that, but the thing is about this isn't